Don't look now, but we have $30,000 house of cards coming at you. And that is how it is. This is fake money, but hey, what's not fake is the fact that you guys have Andrew Mo Money and Professor Bill here with you with the latest House of Cards 2 Part 2. House of Cards Part 2 and Part 3 that came out yesterday. And I want you guys to be able to understand that Austin Tobit, friend of the show, he is going to be coming on to talk exclusively about what he means when he says that the financial system that we are currently running on is running on fumes. It's truly running on a platform that has a due date. And when we start running like the cartoon characters we are, with a little bit of a flair to our kick, we will start to fall, and how this transcends beyond AMC and GME. But let's take a look at it. Too long didn't read, so that at least we understand what this is about. Oh, there's no freaking way that he can do this. Well, let's take a look anyway. And if this video doesn't entice you until the very end, I don't know what will. I'm going to try to keep my commentary to a minimum to help you understand exactly what the word of gospel from Austin Tobit is all about. And if you guys want to make sure that you don't miss out on that live interview on this channel, because he's come on once, twice, 3 times, 4 times. He's a friend of the show. He comes on and co-hosts very often. So if you guys don't want to miss that, bell button next to the subscribe button is for you. And if this video is not up to 1,600 likes yet, you guys know what to do. So 90 seconds away, let's get to it. He wasn't looking into GameStop when all of this began. Most of his time was spent researching the pandemic's impact on the economy. He's talking about the economic steam engine that employs people and puts food on their tables, especially the small businesses that were executively steamrolled by COVID lockdowns. It was scary how fast they had to close their doors. He spent a lot of time looking at companies like GameStop, brick and mortar companies that were basically running out of bricks to shit. Oh, sorry YouTube. Frankly, GameStop looked a lot like the next Blockbuster, and it just seemed like a matter of time before they went under. Had DFV, Deep Effing Value, or Roaring Kitty had not done his homework, it's possible we wouldn't have a Rocket to Hodl or a Story to Total. Okay, fine, fair enough. Okay, let's keep that to a minimum. Whoever has had a short position with GameStop was probably thinking the same thing. The number of shares that can be freely traded on a daily basis is referred to as the float. GameStop has 70 million shares outstanding, but 50 million shares represent the float. With a small float like this, a short position of 20% becomes significant. Heck, Volkswagen got squozed with just 12.8% short position. So let's use little numbers to walk through an example of how this works. And this is for the beginners. This is for the experts. This is for everyone under the sun. So listen up and understand that you have a abstract understanding of what's going on. Let's go through an example to have you get a concrete example. Assume Volkswagen has 100 shares outstanding. If 12.8% of the company has been sold short, then 12.8 shares, or let's say 13, must be available to purchase at a later date, assuming Volkswagen doesn't go bankrupt, which is what the shareholders want. However, Volkswagen had a float of 45%, which meant that there was no real strain to cover that 12.8% short position at any time. However, when Porsche announced they wanted to increase their position in Volkswagen, they invested heavily. The kicker was that Porsche owned 43% of Volkswagen shares, 32% in options, and government owned 20.2%. In plain terms, it meant that the actual available float went from 45% down to 1% of outstanding shares. Bears.com. There's the source right there. Let's visit our scenario. With 100 shares outstanding and 13 shares sold short, what happens if only 1 share was available to cover instead of 45? Well, this is straight up factual historical data from the Volkswagen squeeze. GameStop was the victim of price suppression through short selling. He has actually discussed this with Dr. T, Dr. Suzanne Trimbath, and Carl Hagberg in their AMAs. Every transaction has 2 sides, a buy and a sell. Short selling artificially increases the supply of shares and causes the price to decline. When this happens, the price can only increase if demand exceeds the increase in supply. And this is easy for you to understand. It's just basically using a credit card. Right? You use a credit card and suddenly you can have as many pulled pork sandwiches and Maseratis up to a certain extent that you have wanted, but you always have to pay back that credit card. That is what we're looking at. An entire financial system built from the bottom to the top of credit cards paying off each other. He started looking at closely at GameStop after confirming their reported short position of 140%. It's important for him to explain why this is so much different than the Volkswagen example. 140% of GameStop's float was sold short. There were 50 million shares in that float, so 140% of this is equal to 70 million shares the company has outstanding. This means that at least 100% of their outstanding shares has been sold short. Now compare that to Volkswagen, where the short was only 12.8%. Simply put, it's mathematically impossible to cover more than 100% of a company's outstanding stock. The peak of the Volkswagen squeeze was reached when the demand for shares became surpassed by the supply of those shares. Here, demand represents 12.8% of their stock, which must be available to close the short position. With only 1% of shares available, this guaranteed a squeeze until the number of shares available to trade could satisfy the remaining short interest. So, when a company has a short position with more than 100% of total shares outstanding, the preceding argument is thrown out the window. Supply cannot surpass demand because the company can only issue 100% of itself at any given time. Therefore, the additional 40% could only be explained by multiple people claiming ownership of the same share. Surely this is a mistake, right? I thought this level of short selling was impossible until he saw the number of short selling violations issued by FINRA. And this is one of the 6 bullet points that we sent to Ro Khanna, something that we worked with him live on this show. Something that Austin Tobit and I had been pushing to get it to all of your senators and your congresspeople. FINRA, number 1, FINRA is not part of the government. FINRA is a nonprofit entity with regulatory powers set by Congress. This makes FINRA the largest self-regulatory organization, SRO, in the United States. The SEC is responsible for setting rules which protect individual investors. FINRA is responsible for overseeing most of the brokers, collectively referred to as members, in the U.S. As an SRO, FINRA sets the rules by which their members must comply. They are not directly regulated by the SEC. Case in point, why we saw the SEC chair, Mr. Gary Gensler, and the FINRA president or chair come in the same congressional hearing, which we covered live on the show. If you guys are curious what those faces actually look like, then just search Andrew Mo Money, congressional hearing number 3 for GME. FINRA investigates cases at their own pace. When looking at date initiated on their reports, it is not synonymous with date of occurrence. Many times FINRA will not say when a problem occurred, just resolved. It can be years after the initial occurrence. The DTC participant report is littered with cases that were initiated in 2019 but occurred in 2015, etc. Many of the violations occurring today will take years to discover. FINRA can issue a violation for each occurrence using a one-to-one format. When it comes to violations like short selling, however, these occurrences can last months or even years. When this happens, FINRA issues a violation for multiple occurrences using the one-to-many format. Now, if you guys are interested in entity relationship diagrams, suddenly this is starting to get you nice and excited, hot and heavy. I discussed this event in Citadel Has No Clothes, where one violation represents 4 years of market effery. What's bad is that FINRA doesn't tell you which violations are which. You have to read each line and see if they mention a date range of occurrence within each record. If they don't, you must assume it was for one event. Brutal. FINRA's investment portfolio is held by the same entities they were issuing violations to. Let that sink in for a minute. So that is telling you guys the lowdown, the skinny on how FINRA has been showing up to the everyone pay attention, alerts and violations for the past few years. So this is not an isolated moment. Number 2, state your case. Can you think of a reason why short sellers would want to understate their short positions? Put yourself in their situation and imagine you're running a hedge fund. If you operate in a self-regulated SRO environment and your records are basically private. If the SEC asks you to justify suspicious behavior, you really don't have to provide it. The worst that could happen is a slap to the wrist. They wrote about the exact same thing on Citadel Has No Clothes. They received a cease and desist order from the SEC on the 10th of December 2018 for failing to submit complete and accurate records. This occurred from November 2012 through April 2016 and contained deficient information for over 80 million trades. Their punishment? $3.5 million. So why even bother keeping an honest ledger? This is the kickback mentality. Essentially, you're giving money to the government agencies that basically assigned paltry fines that doesn't actually prevent any of this illegal behavior. So as we are paying attention to how the government profits from criminals existing in the criminal ecosystem, we have a better understanding of who stands to profit when crimes occur. Now, suppose you short a bunch of shares into the market. When you report this to FINRA, they require you to mark the transaction with a short sale indicator. In doing so, FINRA builds a paper trail to your short selling activity. However, if you omit this indicator, FINRA can't distinguish that transaction from a long sale. Who else would there be to hold you accountable for covering your position? This is especially true for self-clearing organizations like Citadel because there are fewer parties involved to hold you accountable with record keeping. If FINRA thinks you physically owned those shares and sold them a long sale, they have no reason to revisit the transaction in the future. You could literally pocket the cash and dump the commitment to cover. So this is starting to get very dicey. Essentially, print your own money and then make it seem like that money was, totally legit. If you can give FINRA a reason, just give me a reason to not investigate you, they're not going to. And they're not going to ever come back to it either. So another very important advantage is that it allows short sellers to artificially increase their supply of shares while understating the outstanding short interest on that security. The supply of shares being sold will drive down the price while the short interest on the stock remains the same. So aside from paying a fine, how could you possibly lose by forgetting to mark that trade with a short sale indicator? It would seem the system almost incentivizes this type of behavior. He's combed through a DTC participant report and found enough dirt to fill the empty chasm that is Ken Griffin's, who is the CEO of Citadel. Take a guess at what their most common short selling violation is. I'm going to assume you said failing to properly mark a short sale transaction. Essentially, basically going into the account books in the IRS, like all the taxes your parents pay, you pay, maybe your kids pay, depends on where you are in life, but essentially lying to the government about what is a short sale. That seems like a huge problem, right? It seems like an audit waiting to happen every single time for the next few years once you discover that. But no, this is just something that happens over and over again. For the record, they want to say that they called this in March when they wrote Citadel has no clothes. Citadel has one of the highest concentrations of short selling violations in their FINRA report. At the time, he didn't truly understand or fully understand the consequences of this violation. After seeing how many participants received the same penalty, it finally made sense. There are roughly 240 participant account names on the DTC's list. Shit you not. They looked at every single short selling violation that was published on brokercheck.finra.org. To be fair, he eliminated participants that was only 1 to 2 violations related to short selling. There were plenty of bigger fish to fry. So reminder what Michael Burry did to find out about mortgage-backed securities and how they were subprime. This man has gone through every single short selling violation on this website. So understand, he knows what he's talking about. Cracks knuckles. He literally picked the first participant at the top of the list and found 3 violations. ABN AMRO Clearing Chicago LLC is the 3rd largest bank in the Netherlands. They got popped for 3 short selling violations, one of which included an FTD, a failure to deliver. So in total, they have 78 violations from FINRA. Several of these are severe compared to their violations for short selling. However, the short selling violations revealed a much bigger story. So ABN AMRO submitted an inaccurate short interest position to the NYSE and FINRA and lacked the proper supervisory systems to comply with practically everything. In 2014, AMRO forked over $95,000 to settle this and didn't even say they were sorry. In these situations, it's easy to think, it could have been a fluke event, so he took a closer look and found violations by the same participants, which made it much harder to argue their case for sheer negligence. Here's a couple for AMRO. So here's a couple more. Read at your own peril. ABN AMRO got slapped with a $1 million fine for understating capital requirements, failing to maintain accurate books, and failing to supervise employees. If you mess up once or twice but end up fixing the problem, great. But if you have your primary business is to clear trades and you fail this bad, there's a much bigger problem going on. It gets hard to defend this as an accident when every stage of the trading recording process is fundamentally fraud. The following screenshot came from the same violation. CME Group found that the firm had improperly used a customer's withdrawn warehouse receipts as collateral for margining purposes. Without these warehouse receipts, the customer's accounts were under-margined on several occasions. So these warehouse receipts are kind of like the receipts you get from buying lumber online. That's a weird analogy, but let's go with it. You can print these out and take them to Home Depot, where you exchange them for actual lumber. Like, you proved you bought them, right? And then you go to Home Depot and then you can exchange that. But instead of trading the actual goods, you can trade a warehouse receipt instead. So yeah, since this one record allowed AMRO to meet their customers' margin requirement, it seemed extremely suspicious that they didn't appropriately remove it once they were withdrawn. Do you think it's an accident? No, because FINRA reported them 8 years later doing the exact same thing. So as a reminder, it's like keeping those receipts and then using them illegally, illegitimately, badly. You are bad for even trying to think about it. Not you, viewer. I like you. But once again, reminder, this is something that they have noticed over and over again. It's not an isolated incident. Once again, AMRO got caught understating their margin requirements. Last time they used the value of withdrawn warehouse receipts to meet their margin requirements. Here, they're using securities that aren't eligible for margin to meet their margin requirements. You can paint the apple orange, but it's still an apple. That's fine. Walk like a duck, quack like a duck. It's still a Ken Griffin. The BS they've read in the reports doesn't really shock him anymore. It's actually the opposite. You begin to expect bigger fines as they set higher benchmarks for misconduct. When they find a case like this, like AMRO, they're going to put more time into it because certain citations represent puzzle pieces. Once you find enough pieces, you can see a bigger picture. So believe him when he says that he's genuinely shocked by the detailed report on the case. AACC understated the portfolio margin requirements for 22 accounts at various points in time. This has been going on for 8 years, from April 2007 to July 2015. Without a doubt, this is the greatest example of violation where the misconduct supposedly ended in 2015, but took another 4 years for FINRA to publish the dang report. If their math is correct, the 8-year relevant period plus the 4 years FINRA spent reviewing yields a total of 12 years. In other words, from the time this problem started to the time it was publicized in FINRA, the kids in first grade had graduated high school. So now you're understanding just the sheer amount of pain that these hedgies are going under, the sheer amount of disaster that they are putting one foot after another to continue feeling like everything's fine. When you see these price actions for GME and AMC, you know that it's not close to fine. I don't want this video to take up too much of your bandwidth, so I'm going to make it piecemeal. We're not only going to cover part 3, but we're also going to cover the next half of this DD in the next video. So I want to be able to thank the people that make this show possible. As a reminder, Mr. Buttervenom is asking to make more We Need More Y-Axis shirts. Those are in the merch store at andrewmomoney.com. So as a reminder, you are you, and you know exactly what is the price point for you to have life-changing money. So don't let anybody tell you the squeeze is over. Don't let anybody tell you when to sell. You decide where, and if it turns out you're a paper hand for doing so, at the very least you had a clear and compelling understanding of the fact that you are part of the largest wealth redistribution in the entire world. And if that doesn't make you feel something, I don't know what will. So we'll see you guys for part 2 of this part 2 of the House of Cards in the next video. Cheers.